In continuation, in the sources of capital, next we are going to see the issue of shares. Issue of share is mainly in two ways, that is equity shares issuing and issue of preference shares. Equity shares are the main sources of finance of a firm. It is issued to a general public. Equity shareholders do not enjoy any preferential rights with regard to repayment of capital and dividend. They are entitled to residual income of the company, but both they enjoy the right to control the affairs of the business, and all the shareholders collectively are the owners of the company. Collectively are the owners of the company. The merits of equity shares are: equity shares are suitable for investors who are willing to assume risk for higher returns. Payment of dividend to the equity shareholder is not compulsory. Equity capital serves as a permanent capital as it is to be repaid only at the time of liquidation of the company. Equity capital provides creditworthiness to the company and the confidence to the prospective loan providers. Limitations: investor who wants steady income may not prefer equity share, as equity shares get fluctuating returns. The cost of equity shares is generally more as compared to the cost of ravishing funds through the other sources. Issue of additional equity share dilute the voting power and earnings of existing equity shareholder. More formalities and procedural delays are involved while raising the fund through issue of equity share. Next comes the preference share. Preference share allow an investor to own a stake at the issuing company with a condition that whenever the company decides to pay dividends, the holders of the preference share will be the first to be paid. This shares often with no voting rights which receive the dividend before all other shares are not repaid first at the face value if the company goes into liquidation. Merits are: preference share provides reasonably steady income in the form of fixed rate of return and safety of investment. Preference shares are usual for those investors who want fixed rate of return with comparatively low risk. It does not affect the control of the equity shareholders over the management, as preference shareholders do not have voting rights. Limitations: preference shares are not suitable for those investors who are willing to take risk and are interested in higher returns. Preference capital dilutes the claims of equity shareholders over assets of the company. The rate of dividend on preference shares is generally higher than the rate of interest on the debentures. Then comes the how it is equity shares with preference shares are done. There are some difference between equity shares and preference shares. It is based on the rate of dividend, arrears of dividend, voting right, payment of dividend, and convertibility. First, we will see the rate of dividend. Preference shares are paid dividend at a fixed rate, whereas the equity shareholders, the dividend may vary from year to year and depending upon the available of the profit. Arrears of the dividend. Holders of cumulative preference shares can get the arrears of past dividend, but equity shareholders cannot get the arrears of the past dividend. Voting right. Preference shareholders do not have right to participate in the management of the company. Equity shareholder enjoys the voting rights. Payment of dividend. These shareholders, that is preferential right to receive dividend before any dividend is paid to equity share. Payment of dividend to equity share is made only after paying to the preference share. Convertibility. The preference shares can easily convertible, but the equity shares cannot be convertible. Thank you. The other things of sources of capital, let